Hi. So in this section we'll talk about IRR page. IRR page in a purchase price allocation model serves several purposes. The main purpose from the modeling standpoint is to calculate the internal rate of return for the transaction. And on this page, it's this number 19.4. It's the internal rate of return that's embedded in this transaction. The internal rate of return is defined through solving back to the discount rate such that the projected cash flows, free cash flows, which are outlined in this section, discounted would equal to the total purchase consideration of this transaction. In order to compile the IRR schedule, which is one of the key schedules in the analysis, one has to have the financial forecast, which is typically provided by the management. Financial forecast may be provided by the management through the EBIT line, or more information could be provided, such as forecasted balance sheet or forecasted cash flow statements. That way there's more information to incorporate in the forecast. But the EBIT line, from their taxes, depending on where the transaction's at, most of the acquirers are here based in US, and so their tax rate is typically statutory 40% assumed. There's obviously situations where a client provides the explicit tax expense forecast and then that number is being used. Additional adjustments to the debt-free net income are changes in the net working capital, depreciation and capital expenditures. Note that it's debt-free net working capital. In other words, no interest expense should be used anywhere in this model. The incremental working capital could be calculated based on the percent of revenue that the company is typically keeps in the cash-free net working capital. Depreciation and capital expenditures, those two line items could also be forecasted based on the information provided by the client, or it could be based on the comparable companies and their financial matrix. Note that in the terminal year, regardless of how depreciation and capital expenditures are calculated, depreciation and capital expenditures have to be the same. Terminal value, and then discounting is done with the use of the mid-year convention. In other words, the cash flows that are assumed in this analysis are forecasted. It's all those individual cash flows are assumed to arrive in the middle of the period. In other words, if we look here at the year 2013 free cash flows, this $5,675,000 arrives to the client's bank account on June 30th. And so from that standpoint, you have to measure the amount of time between the valuation day and June 30th, 2013 for the purposes of calculating discounting factor. In this particular model, you'll see years to cash flow. In this case, it's 2.62, and the model has the formulas to do that. In addition to discounted cash flows, discounted value of terminal value, there are other adjustments that one needs to make before you arrive at the total consideration, and those have to do with, first of all, adding back cash and equivalents. As you might have noted, incremental net working capital is calculated based on the cash-free incremental net working capital. Net working capital adjustment, it's an additional investment or potentially a draw that the client can make as a result of this acquisition. In other words, if the balance sheet of the acquired entity has excess net working capital, then that actually reduces the cost of that acquisition. If the acquired company has shortage of net working capital, then additional investment in the balance sheet is required. So this number reflects that. And in this particular situation it wasn't the case, but intangible tax amortization benefit has to be added in the situation where the transaction is structured such that for tax purposes the intangible assets can be amortized. In order to determine whether this amortization can in fact occur and provide that benefit to the acquirer, one has to ask the client whether the acquisition was a stock purchase or asset purchase. If it's an asset purchase, then you do include tax amortization benefit. If it's a stock purchase, then you have to ask the next question, which is whether the company made a so-called 338 election. 338 election is the election for tax purposes that allows to realize that step up in basis and again leads to the benefit. In other words, for tax purposes, if the acquisition was a asset acquisition or if it was a stock acquisition with 338 election made, in both of those situations you have to calculate intangible tax amortization benefit. If it wasn't the case, then you have to make sure that you include NOL, net operating losses calculation, if there were any on the target's books.